and you think, shit, I might be missing it. And that creates a fear of missing out, which is FOMO, which creates irrational behavior and emotional buying. Now, first of all, your job is to not join in on that. How do you beat dumb money? By not copying them. The thing you don't have to do, this is where people get it wrong as well. You don't have to go opposite to them. This is a mistake. A lot of times people will say, okay, I understand what Michael's saying. Price goes down, people get bearish. Price goes up really fast, people get bullish, and they want to buy here because they feel like it's going to run away and they're going to miss out. In reality, I know it's probably going to go something like that, and it's going to go down, right? And your first thought is, well, why don't I short it? Why don't I do the opposite of what the dumb money are going to do? But that's not the opposite. It might technically be, right? If dumb money wants to go long, you could say, I should go short. But what dumb money are doing is they are FOMO buying. The opposite of that is not to sell. The opposite of making the FOMO buying decision is to just not buy. And the same if it goes down. Fear selling. But let's stick with the FOMO buying. I can't stress enough how important this is. Because when you don't think that the market, it's easy to think that if you're not making trades, you can't exploit the market, right? If you never make a trade, you can't make any money. That's where the logic comes from. So when you think you have an idea of what dumb money are doing through price behavior, it's tempting to take the other side, but please don't. Understand that if you don't buy when your brain tells you to buy, and you do that and you avoid that urge 100 times, you will beat the dumb money. Because they will lose money, you won't lose money, and over a long series of trades, or non-trades for you, but trades for them, that could mean two people start off with 10k each, one person ends up losing 8k, the other person ends up with 10k. Right? If you imagine they never did anything, and the other person took their FOMO trades, one person would protect their capital entirely, the other person would lose. Not losing is winning. Not losing is winning. Protecting your capital is winning. Now, growing your capital is a separate topic, and that will come with time by following your systems, your plans, your trades, all of that. But it's really, really, really important to understand that. I think that a lot of you, especially my purple belts, masterclass students, captains, the ones I've seen and mentored and spoke to more, a lot of you have a very good understanding of your trading psychology, right? And you understand when you feel fear, when you feel greed, when you feel anxiety, any of these emotions, right? And many of you talk about it, which is really good, by the way. Speaking it and talking about it and sharing it clarifies it for you as well as for other people. And you journal it, you write it down, and it helps you to see things clear. That itself is one of the most important things for your long-term survival and winning. It reminds me of the Jesse Livermore quote from Reminiscences of a Stock Operator. He said, focus on the downside, right? All you have to do is protect the downside. You focus on the losses, and the wins will take care of themselves. Manage your losses, the wins will take care of themselves. That also extends to avoiding losses by doing things that you know you shouldn't be doing. Right, so anyway. One of the things that then happens from this is that when price has a move, whether it's down or up, but let's say it's down, and then it bounces up, and it leaves a gap. So you all know what a gap is. And I'll go in more depth on gaps later on this lesson. And it looks like it's going to, and it's always the most important thing, it looks like it's going to break out and not pull back. It's leaving the most obvious play possible, which is a false breakout. Now, if you've traded for any amount of time, you'll know what a false breakout is, right? Very common. They happen all the time. And, it's like no matter how many times they happen, right? No matter how many times you see false breakouts, they continue to happen. Because there's always going to be people, like I said, you can always rely on dumb money to do dumb money things. You can always rely on somebody to buy here because they are emotional. FOMO. I sold here. I can't wait any longer. I have to get in. What happens? It tries to break out and it fails to. Right? Goes up, tries to go up, tries to break out, doesn't, comes down. Where does it attack? The most recent lows. Why? Because somebody who can't wait to get in is also likely, and this is where you're starting to think about price behavior, right? The type of person who is likely to buy in the wrong place is also the type of person who is going to put their stop loss in the most obvious place, which is below the most recent low. Not down here, where it would actually be safe, right? If you're talking about this trend, if this trend is going to continue, you would say that level should not get hit. If we've reversed, this level can easily get hit. That happens for two reasons. One, what I said, the person who buys in the wrong place will also put their stop in the wrong place. If you make one bad decision, you're probably going to make two. Because clearly you've shown a lack of discipline and a lack of basic understanding. The other reason is very simple. It's leverage. The type of person who will buy or sell, but the type of person who will buy in FOMO, buy on emotion, is also the type of person who's going to not put their stop here because it's too far away and they need to use leverage. Right? That's 2% away. Putting it 6% away is just way too far. They can't put enough size on. They can't get a big enough trade with enough leverage. So you can see how these bad decisions and the patterns of them, they compound. The person who buys in the wrong place will put their stop in the wrong place. The person who buys at the wrong place will use too much leverage because either they're trying to, get more out of the trade, or something very simple. Because they're a loser, because they're doing the wrong thing, they probably did the wrong thing here. And so what does that mean? They lost money. They were probably long here, right? And stopped out. And then they started shorting here and got stopped out. So they've lost money. And whenever you've lost money, if you're a dumb money trader and your psychology is wrong, the first thing that you think about when you've lost money in the market is what? I need to make this back in the market. I lost $1,000. I need to make back the $1,000. And this is where you can exploit price behavior, dumb money psychology. Because what's the chances that somebody, if you think about it rationally, what's the chances that somebody who lost $1,000 in the market through bad decisions is going to make it back in the market by doing the same things? Because they don't change their strategy. They don't realize, maybe I'm doing something wrong. They're just gripped by the make it all back mindset. So that's why you can quite easily, if you sit back and think about price, you can quite easily start to understand some of these moves. Now, there's a difference between understanding the moves and then actually trading it. But the understanding comes first. The person who makes one bad decision is going to make 2, 3, 4, 5, 6. The person who makes one good decision is more likely to make 2, 3, 4, 5, 6 good decisions. You want to put yourself on that side. So, when you see price and it looks like and feels like it's not going to pull back, you want to be looking below, not above. It will go above first, but you want to be looking below. And that might be a sweep-based system, right? You might be looking at these. And by the way, test it. Everything I talk about here should be tested. Don't take these things and say, this is the gospel truth and nothing else could happen. Every single time there's a breakout, it must go to that level. No. Go and back test it and say, okay, wait a minute. Here's an exact system you can go and test right away. First thing, attempted reversal. That could be down or up, but obviously we're going down, right? So previously, price is moving up. Price moves sharply down and breaks structure. This is important. It breaks structure, it breaks structure. So it looks like and feels like it's actually a downtrend. That's important because that will trigger people to start shorting. People who say, okay, this is now bearish because for valid reasons. Break a structure, break a structure, break a structure, or break down. So price is moving one way, up. It suddenly has a valid reversal, but the reversal gets invalidated. It moves the other way. And then what happens after the next breakout? If you have a liquidity area, the lowest low before that breakout, how does price react down there? I can tell you from experience, you will have a high instance of these areas getting an instant reaction. Now, you then, if you want to go further with this system, if you want to execute on it, this doesn't mean that Bitcoin is then going to go like that. The trade might just be this. The trade might be buy the sweep, put your stop loss wherever your testing will show, put your stop loss somewhere you feel like it shouldn't go, and exit on the bounce. And then because what you'd be doing is you'd be looking at this in a lower time frame, right? And you'd be looking at, you could look at something like this. Bounces up into this previous gap here. See that? Breakdown point, comes back up. Maybe you just exit there on the first bounce. It doesn't have to mean that we're going to the moon. All you're looking for is where could price react? Well, price will react from liquidity, which is previous lows. And obvious ones. That's why you take your higher time frame, right? If you're trading that in a 5-minute chart, look at your 1-hour chart and say, where is the most obvious place for stops to be? It's there. This is where stops should be, but greedy people who are trying to make back their money will use a tighter stop, and that's who we're trying to wreck. That's who we're trying to counter trade, right? And why there? Why this level? It's the lowest point before the breakout. The lowest point before this breakout. After the gap candle. This gap candle is the part that made people start to think, oh, it might not pull back. Why not here? Why not here? Because they're not obvious enough and they're too far away from price. These, by the way, if price went to here, it would react. If price went to here, it would probably react. But first of all, it's going to go to here. So go test it if you want to. If you want to test that system, right? Now, next. We're going to look at gaps. Why do gaps form? And why do they fill slowly but form fast? So, a gap is based off an imbalance in price. I guess I'll first of all, I have lessons on this, but I'll first of all explain what gaps are, right? And we'll zoom back out. We'll look over here, because this level is, or this move, sorry, is a good example, right? Here we go. Take that off. Take this off, and can take that off as well. And we'll look in here. And we'll come back to these other things in a minute. So, price moves fast in one direction. That will be seen as a number of candles in the same direction. That could be 3, 4, 5, 6 red candles or green. In this instance, it's red. Down, down, down. Now, a gap, if you want to use it in terms of like a fair value gap, it's from the lowest point of this wick. And then when you have a candle that moves all the way down and does not move back up, the area that's untested is here. Right, so right now in this chart, the lowest wick here to the highest wick of that following candle. Why? Because that's as far as that candle pushed up, barely pushed up at all. So you had a breakdown, and instead of retesting it, it broke down further. Play it on, you see the same thing again, and another one form from here to here. So now you're starting to see some gaps forming on the chart, as you have a number of candles in one direction. Now, moving on again, you'll see another one. And we're starting to see these gaps form. So I'm just showing what the gaps are first, and then we'll explain why price moves down fast and up slow. And then, there we go. Fills that first gap straight away. And then the rest of this moves much slower. So it only takes 4 candles to go down, so 4 hours, but it takes 20 or 30, I think it was, to really go all the way. Let me see, go all the way over here. There we go. It takes, about 24, almost a full day to fill that in. So why does it take 4 to go down and, to be exact, 22 to go up? Why does it take 5 times longer for it to fill? The answer for this in price behavior is something that I couldn't wrap my head around. Because I could always understand why price would do this. I understood it because I understood, okay, if price moves suddenly in one direction, you might get liquidations. The market's over leveraged, people are getting stopped out, there's not enough buyers coming in, there's an overwhelming amount of sellers, it moves really fast in one direction with it. What I couldn't understand is, why doesn't it just go straight back up? Why does it almost always take longer to move back up? And after a long time of trading and seeing it and thinking about it, I realized this is actually the natural state for the market. That is how it should move. This is actually not how the market should move. Because if you believe that markets are generally efficient, they shouldn't have these one-directional moves on any time frame. And the reason they fill is because this is what the market actually wants to do. The reason it moves down is because you have a catalyst. That could be breaking news, right? It could be CPI, economic data. It could be bearish news or bullish news that breaks, that causes the market to imbalance. Or it could just be simply liquidations. A lot of traders are getting stopped out in one direction or the other. And once that ends, right? Once that finishes, the market will go back to the state it wants to be in, which is efficient. Another reason, fast moves cause emotional traders to expect more fast moves. This is like what I said a minute ago. Recency bias. Because the market most recently moved really quickly down, people either expect that it moves really quickly up or really quickly down in the same direction. So the reason why it bounces slower and fills it slower is because that's what will cause the most pain. The people who are shorting are getting stopped out, and they try and short again, and they get stopped out. And they try and short again, and they get stopped out. And they try and short again, and stopped out, and stopped out, and stopped out. And it's slow, and it's grinding, and it's brutal. If you've traded, for any length of time, you've probably felt this, where you feel like you're completely on the wrong side of the market. You feel like when you buy, it goes down, when you sell, it goes up. That's quite often because you've fallen into that negative pattern of thinking with recency bias and expecting the most recent occurrence to continue. So, gaps happen fast. That's their nature. They have to happen fast or it wouldn't be a gap. And they fill slow. So gaps form quickly and fill slowly. That's the rule. That is not 100% of the time what happens, right? Because you can sometimes see, like over here, gaps up really quick, gaps down really quick, right? Up and down, all in a 1 hour candle, either side. But generally, they will form quickly and fill slowly. Reason, catalyst. Once the catalyst has ended, whether it's liquidations, whether it's breaking news, and the news gets fully digested, the market will move back in the other direction. As soon as you have a reversal. So if you're trying to trade this, you want to see signs of reversal. Now, if you're on a 1 hour chart, you'll have to go to a lower time frame. Say you go to a 5-minute chart. You're looking at the reversal, which could be something like this. Price comes down into this area. There's a couple of levels around here, and there's a sweep there, and it goes below, comes back above, and it breaks up, and breaks up, and breaks up, and then it comes back, and it retests, and it breaks again. Over here at this point, you're looking at this saying, oh wait, okay, it's gone down, 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 down. It's tried to reverse, gone up, up, up. It tried to go lower again, and now it's breaking back above that breakdown level. Once that starts to happen, your expectation should be zoom back out to your 1 hour or whatever time frame, your higher time frame. And at this point, you should be expecting the full gap to fill. It won't always, but the reason why you have rules is that it's what should happen. Should does not mean will. It's not 100%, but more often than not, it will. So if you're if you see a sudden bearish move, the best place to short is when it fully retraces. Not half the way, not quarter of the way, fully, when it fully fills that gap. That is the best place to start looking at potential continuation shorts. Again, it won't always get there. But your probabilities are much higher, your expectancy is higher, and your risk reward is in your favor if you have the patience to wait for the full gap to fill, wherever the origin of the impulse came from. Second part, or third part of price behavior, I want to talk about price needing to slow down. I touched on this, I think, earlier this week. When price moves suddenly in one direction or the other, it should slow down. Now, you can actually see this on a weekly chart. This is what Bitcoin has been doing since the ETFs launched. This is very, 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 very common. And what it means is you move up really quickly. In the space of 7 weeks, you have a move from 40K to 74. And then price does not go higher and it spends time going sideways or down or correcting, whatever. But it spends time going the opposite direction, which is not trending, and into some type of consolidation. Why does this happen? When price moves fast, it moves away from fair value or balance. You can view this with moving averages. I put on the bands, and you can see over here, if this is an uptrend, this is a perfect place to buy. Why? It's tight to the bands. It's retesting them. Right? Then it moves up and up and up and up. And as it moves, it gets further and further and further away from those bands to the point where, at the peak, it's really far away from the bands. Why does that matter? Every trader, whether it's low time frame or high time frame, is trying to identify an oversold area or a fair value to buy. They're not trying to buy something that is overbought, which is what this indicates. When it's really far away from moving averages or really far away from the last gap, right? Like from the last consolidation, from the last swing, traders will not want to buy that. They should not. And because it moves, if you think about it in terms of supply and demand, if Bitcoin was worth 40K in January, right? And then by March, right? mid-Jan, late Jan, it's worth 40k. And then by the early March, it's worth 74. That is a rapid change of price, which makes traders, because again, it's not been long since it was there. So in your head, you think, wow, well, 74 is expensive, relatively, in terms of recent history. I remember Bitcoin being 40k just a few weeks ago. It's now 74. And as it goes up, it can keep going up, but as it rises, buyers are going to be less and less inclined to keep buying, because this thing that was considered cheap or fair value just a few weeks ago is getting more and more and more expensive. And because something gets more and more expensive, it attracts what? It attracts sellers, naturally. It doesn't matter if you think that Bitcoin should go to 100k. If it goes rapidly from one area to another, one level to another, and rises significantly, it will attract sellers. So you've got the perfect storm to end a trend, which is buyers are less willing to buy because it's way more expensive than it was very recently, and sellers are more willing to sell, not because they're bearish Bitcoin, not because they don't think Bitcoin can go to the moon, or any coin, but because they realize it's probably moved too far too fast, and that's how you get some natural selling coming in, and price will move back or sideways until the bands or the support level gets retested, whatever it is, catches up. Price needs to slow down. Consolidation is price slowing down, whether it's in an uptrend or a downtrend. Because markets are driven by emotions, they will move very quickly in one way or another, and they will move too far. The market, clearly, just look at the candles. Clearly, the market is not very efficient. If the market was efficient, why is the price changing so often? It changes so often because people are inherently emotional, and psychology dictates broadly where the market goes. So, because it moves from an area of being cheap to fair value to overbought, it will pause and slow down and trend back. In terms of price behavior, the way you want to view this is the consolidation, right? If it goes up for 7 weeks, it's going to take way longer than that. I can't put a number on it because there is no exact number. Studies have been done that show markets trend about 15 or 20% of the time, and the rest of the time they're in consolidation. So if you viewed that and you saw a 7-week uptrend, if that's 20%, you'd probably be looking at 28 weeks of sideways, right? 35 in total, 7 out of 35 being 20%. You could expect to see 4 times as much consolidation as the trend. Now that's a very rough estimation. It's never perfect. The main thing you should see and know is that when you start to see signs of price slowing, you should expect it to slow down, consolidate until it builds up the energy for the next move. That happens on a 1-week chart and it happens on a 1-hour chart. You know, on Thursday at 4 p.m., Bitcoin was 59k. 4 hours later, Bitcoin's 56. So even if somebody is bearish and they think Bitcoin goes lower over the next days or weeks, if they're short, the correct thing to do is take some profit. If price moves really quickly in your favor, you should consider taking some profit. That's the logic. And counter trend moves happen all the time, right? You know this. Nothing ever goes straight down or straight up forever. In every downtrend, there are rallies. In every uptrend, there are pullbacks. And the way you can spot them is the faster price moves, the more likely it is to move then after that into some kind of a consolidation. And like I said, the 20% and 80%, what did this? Basically 4 hours down, 22 hours up. What's that? roughly 80-20. Trends down for 20% out of this move and bounces back up, consolidates, because it's not trending, it didn't break the highs, consolidates for 80%. So keep that in mind about price needing to slow down. Now, adding on to that, price moving fast will do what? It will get emotions spiked. When price moves fast, people get liquidated, they get stopped out, they change their mind, they change their bias, they want to follow in on a short, they want to panic and sell, or buy, depending on the direction. And that creates the perfect conditions for a counter trend move. So when you see a fast move, your first expectation should be it's not going to move thereafter. It's going to stop. Whenever Bitcoin collapsed after FTX, this is probably in my years of trading outside of COVID, this is the most emotional, fear-driven market I've seen. Was this move when FTX, the second biggest exchange, collapsed. And everyone's funds who didn't take money off, everyone's funds disappeared. But what happened? You had 5 days of selling, right? Or 4 days of selling. And then you had 2 months of nothing, sideways. It ended up being the bottom. It could have went lower. The point is, when you see these massive, like a massive collapse, the market is very likely going to do nothing. And what does it do? Nothing, until the moving averages catch up, until it finds some kind of balance, until the market sets itself into an area where the next move can happen. Now that one was up, it could have been down. Next, I want to talk a bit more about sweeps. So get a lot of questions about liquidity sweeps. Why do they happen? Right, so we'll take the higher time view. I covered it a little bit at the start of the stream, but let's just look at this one. Right, we've got this big move that Bitcoin had where it went right down below the low and then it reversed. Okay, so why does this happen? Why does the market go below a low and then bounce? Or why does it go above a high and then reverse? You have to understand the logic behind sweeps. Sometimes people say, well, it's going there because market makers are manipulating it and they're hunting your stops and they're trying to, generate liquidity. And there's elements of that. But it's not a single market maker. It's not a whale. It's not one person trying to manipulate you or target your stops. Price seeks liquidity. Because first and foremost, markets exist to do trade, to do business. Right? The market exists. Every marketplace exists to facilitate trade. I've said this before in the past. If you had a fish market, where would you put the fish market? In the city center of an inland city? Or in a coastal city or town near the seaside? Where are you more likely to sell fish? By the seaside. That's why there is always more fish markets in coastal cities and towns near the water than there are in inland cities nowhere near the water. Very much like that, the market is always seeking liquidity. Liquidity in this sense is just somewhere that trades can be transacted, where business can be conducted, where buyers and sellers can meet and exchange coins for whatever price is at. The market doesn't want to stay still. This is why it never stops. This is why every single minute of every single day, the market's moving. Now, why does it have a tendency to go above highs and below lows? Because there is guaranteed liquidity there. Below this low, there's two types of participant. One, you have breakout traders. Talked a minute ago. Every time price breaks below a low or above a high, some people are going to play the breakout. Why? Because if the breakout is legitimate, you get the best possible entry, because sometimes there's breakouts that never come back, and if you're correct, you capture a big move and you take very little drawdown. If you want to look at these where they succeed,